You could have $550,000 of equity in that rental property portfolio of yours and still only be collecting $1,000 a month. The problem is that most rental owners are calculating their returns using the wrong number. 10 years ago in Boise, the median house price was about $250,000. So let's say you bought yourself a couple of those houses with your typical 25% down payment, so about $100,000 out of your pocket. In 2026, those properties would roughly double what you paid. So now maybe you're sitting on equity of around $550,000 or so across those two houses. Market rents on those properties right now would be somewhere between $2,200 and $2,300 a month each, so let's call it a combined gross rent of $4,500. Two mortgage payments totaled around $2,200 a month combined, so that leaves you with roughly $2,300 a month to handle property management, maintenance, and your vacancy reserve, capital expenditures, etc. If your expense budget as a percentage of your gross rent is roughly 10% for property management, 8% for maintenance reserve, 6% for capex reserve, and 6% for a vacancy reserve, that comes out to about $1,350 a month. So your passive income would be about $1,000 a month or $12,000 a year. Now against your original $100,000 down payment, that's 12%, and it feels pretty great, right? But appreciation and mortgage paydown have pushed your equity to now $550,000. So in reality, you're not deciding what to do with $100,000 anymore. Now you're deciding what to do with $550,000 because that's how much equity you actually have now. Here's the first big takeaway from this video. Return on current equity is the number most landlords never calculate honestly, and net cash flow has to mean net of everything: debt service, management, maintenance, vacancy, turnover, insurance, taxes. A real reserve for capital expenses as well. Not just a good month, the number before you realize you need a new HVAC or a new roof or whatever else the house might need. I'm talking about the actual trailing 12-month number. And if you're wondering why that number is so thin, here's why. Single-family rental returns are engineered to pay the person who's generally supplying the labor. So if you're self-managing and you're doing all the repairs yourself, yeah, maybe the math works great. But if you're outsourcing management and you're outsourcing those repairs, well, the returns can shrink quite a bit. Now, let's do a quick reality check. As I record this, the 10-year Treasury pays about 4.66%. I'm recording this on August the 14th, 2026. Obviously, a house and a 10-year Treasury are not an apples-to-apples comparison. They have different liquidity, different taxes, different upside, different risks. But just sit with this for a second. If an illiquid investment that still needs your attention is producing less current income than a Treasury, you should at least be able to say why you still own it. Maybe the answer is appreciation. Maybe it's the tax benefits. Maybe it's a 3% mortgage that you're never going to see again. And those can all be legitimate answers. But I've always owned it, or I've always owned rentals. Well, that's not really a solid investment thesis. That's just a long-term habit that you haven't broken. Now here's what makes this decision hard. For a lot of long-time owners, the buy and hold strategy has obviously worked extremely well. The median home price in the US just hit $440,000 and change, all-time record. 36 straight months of year-over-year gains. Harvard's Joint Center for Housing Studies says prices are up 54% nationwide since 2020. The median home now costs nearly 5 times the median household income. Through the 1990s, that ratio averaged about 3.2. So obviously, I'm not arguing that your rental properties failed. I'm just saying they may have succeeded so well that appreciation became almost your entire return, while the income yield on your growing equity has quietly collapsed. Maximum equity, minimum current yield. That's what I mean by trapped equity. Not trapped because you can't touch it, trapped because touching it forces a real decision. Refinance, sell, exchange, or reposition the proceeds into something else entirely. Every one of those decisions has costs and risks. So does doing nothing. It just doesn't send you a bill. So the obvious next question for many of you that are watching is, should I wait for prices to go higher or sell before they fall? And the reality is I can't answer that. Neither can anyone else on YouTube. Prices could keep climbing, they could go sideways for a decade, your market could fall while others rise. So here's a better question. Not what will the market do? What job does this money need to do for me now? That's the better question. At 35, trading current income for leverage and decades of compounding is a great deal, and I take it all day long. But guess what? I'm not 35 anymore, and probably neither are you. At 55 or 65, we have a different runway and different priorities. I don't know about you, but these days, my main goal is more current income with as few operating decisions/headaches as possible. More weight on protecting principal than on squeezing out every future dollar of appreciation. Now, that decision doesn't make one strategy better in the abstract. It means the structure that built your wealth may not be the structure that you want to depend upon for current income. Obviously, neither one of us can control or predict the market's direction. AI is making all sorts of waves in the news, and uncertainty is about as high as I can ever remember. For me, instead of burning brain cycles trying to predict which way the market is going to go, I instead focus on what I can control, where I sit in the capital stack, and which risks are acceptable to myself and my family. That's the whole video in one sentence. Everything from here on in the video is the how. Now I want to talk about where my wife and I made our most recent investment: real estate private credit. As a private credit investor, instead of owning the properties, we're actually now funding loans secured by the properties. Same asset class, but a way different seat in the capital stack. And here's why that seat matters. In a typical deal, the first lien holder gets paid before anyone else. In other words, if the bank holds your mortgage, guess what? They're getting paid before you earn a profit at all on a rental property. So if the property loses value, the owner's equity, in other words, you, absorb the loss first. And with housing prices at all-time highs and an economy with as much certainty as we have, I can promise you I really don't want to be the guy absorbing the loss if things go wrong. Now, being in first position isn't magic, and I want to be straight with you about that. Foreclosure takes time and costs money. Property taxes, legal fees, estate appraisal, a building that deteriorates while you fight for it, all of that can eat into a lender's recovery. Lending does not eliminate risk. It changes which risks you're exposed to. Now, I learned the distinction the expensive way. In 2021, my wife and I put $100,000 into the equity of a multifamily syndication. The sponsor used floating rate debt. And yeah, I know in hindsight, you might be thinking, my God, what were you thinking? But guess what? Nobody predicted that rates were going to spike the amount that they did in early 22. So when those rates spiked, obviously values fell, and now we expect to lose that entire $100,000 investment. The building was real and the tenants paid rent every month, but we owned the last lost position in the capital stack. Last in line means last to get paid, and in this case, there is, thanks to the decline in the building's value once it's going to be sold this fall, there's going to be likely nothing left to give back to us and all of the other equity investors in this deal. But what about the bank? Well, the bank got paid the entire time because if they didn't, they would have foreclosed and taken the property a long time ago. So that loss changed the first question I ask before I invest in anything. I used to ask, what's the projected return? How much can I make? These days, my first question is, what protects my principal if the projection is wrong? For me, a conservatively underwritten claim on collateral beats an equity claim that needs rent growth, expense control, financing, and the exit price to all cooperate at once. I don't know about you, but nothing in my career has ever required everything to all go right at the same time and then actually delivered on that. The world simply just doesn't work that way. Things go wrong all the time. Now let's dive a little deeper into this thing called real estate private credit. When I evaluate a mortgage fund, the first two numbers I look at are lien position and loan to value ratio. The fund my wife put her IRA money into reports a portfolio average loan-to-value of approximately 45%. That's pretty low. At that loan level, 45% LTV means that a property worth $1 million secures a loan of just $450,000. It definitely doesn't take a genius to realize that $550,000 is a pretty serious equity cushion to protect my money. But here's the thing. I'd never accept that average by itself because averages can hide risk. I want to see the highest LTV loans in the loan tape, the distribution, property types, geographic concentration, appraisal dates, fund level leverage, and what actually happened in every prior default if there were any, because yes, a debt fund can still lose money. Here's how. The appraisal was too optimistic. The borrower stalls before finishing the business plan. The property deteriorates. Foreclosure costs chew through that equity cushion that I've been talking about. Several correlated loans go bad at once. Or the simplest one, the manager just underwrites badly and they choose bad loans. Collateral is protection, but it is definitely not a guarantee. And private funds can be illiquid with less disclosure than anything you'd buy in a brokerage account, which means manager selection and due diligence aren't a detail. They're most of the job. That's the part the glossy presentations skip. It's also the part that I care about most. Now, back to that $550,000 in equity we talked about earlier. In the rentals at 2.2%, it produces about, as I mentioned, $12,000 a year. In the fund we've invested in, that same $550,000 would generate around $65,000 a year. That's more than 5 times the targeted income. Now, with that said, my comparison isn't finished until you price the trade. And that means there are 4 things we need to take into account. 1, you can't reinvest the full $550,000 because selling a property costs money. Commissions, closing costs, paying off the debt, federal and state taxes, and the tax bill on all that depreciation you took. Talk to your CPA and get your real net proceeds number. Don't guess. Number 2, while the current yield on the fund that we're invested in is right around 12%, they are slightly ahead of their 10% target, and the rate of return is definitely not guaranteed. Borrowers can still default, distributions can be cut or suspended, you can lose principal. All of this stuff is possible. But of course, given the structure of the fund, it's my opinion that the probability of that outcome is extremely low. And the fund's track record absolutely backs up that assumption. Number 3, illiquidity is real. The fund I'm in has a 12-month initial lockup, and even after the lockup, redemption terms, notice periods, and gates, well, all of that stuff matters. A lockup period coming to an end is not the same as instant liquidity, so make sure that you, whenever you're evaluating a fund, you read all the fine print in the offering memorandum. Number 4, you give up the upside and you give up the steering wheel. If your old rentals double, you don't participate. And you've traded property level control for manager risk. So the honest comparison was never 2% versus 10%. Instead, it's like this. What will your rentals realistically produce from here after every cost, every hour, every risk? What could you actually net if you sold? And which structure manages the income, liquidity, and risk that you need in your life right now? To help you with the math on selling, I've actually got a trapped equity calculator right on my website. If you visit investwithtrent.com and you look right on the homepage, you're going to see a button that will take you right to it. Then all you have to do is punch in all of the numbers, whatever your tax bracket is, the state where the property is located, etc. It will take into account all of the selling costs, as well as calculate what your new higher rate of monthly income would be if you sold that property and moved the money into the fund that I run or a fund like the one that I run. Now, as long as you know the numbers for your given specific property off the top of your head, using this calculator will literally take you less than a minute, and I'll bet you'll be pretty surprised at how much more income you could generate than what you're generating now. Now, I'm not saying that you should sell your rental property because you watched this video, and you're probably not thinking that either. I'm also not saying that you should run out and invest in a real estate private credit fund because you watched this video. Instead, all I'm suggesting is that you should calculate the return on equity that you already own. Use that trapped equity calculator that I just mentioned. You can punch in your gross rent, your mortgage payment, and of course a realistic number for all of those expenses. Now remember how I talked earlier in the video about buying a house in Boise at the median house price of $250,000 with 25% down? Well, assuming that the property has now been owned for 10 years and you didn't take any equity out, my monthly net cash flow was about $475 on that property, on that model example. If I sold that property, commissions, taxes, and so forth would come right in at around $78,000. Again, that's this property, a median house price that I bought, say, 10 years ago. So I'd pay about $78,000, which would now give me roughly $241,000 of cash available to reinvest in something. If I invested that in the fund that my wife and I are invested in, it would produce about $2,400 a month in income. That is a 5x increase in monthly income. Now, a reminder, of course, you're giving up the capital appreciation, but if your priority is income, maybe this just makes more sense for you. Once you try the calculator with your own numbers, then ask the only question that matters. Is owning and potentially self-managing a rental property still aligned with the objectives that we have in our lives today? Most likely, your rentals have already done a terrific job of increasing your net worth. The decision in front of you is what job should that equity be doing next? My name is Trent. Thank you very much for sticking with me to the end. And if you decide to go ahead and use that trap equity calculator on my website, you'll also receive email notifications when I produce future videos. Thank you very much for watching and hanging out with me. I look forward to seeing you in the next video soon. Take care. Bye-bye.